Okay, so I think we'll get started. While I'm talking, please feel free to send any questions, things that might crop up using the Q&A chat function, and I'll answer them all at the end. But that means that you can post the questions while we're going ahead, rather than having to type frantically at the end. So the title kind of gives a game away, really. Yellen's patience running out, rates to rise sharply next year. It's been quite a change. I think a lot of people in the market struggling with the idea that Yellen's view is changing. She's been viewed as a perma-dove for a very long time. I've never really bought into that idea. I think she's been a dove by circumstance. It's pretty easy to be dovish when you're a firm believer in the narrow and the unemployment rate's still pretty high. But things have changed because the unemployment rate's now 4.2, and crucially, it's still falling. I'll come back to that. Still falling and likely, I think, to be below 4% either by the end of this year or certainly early next year, and well below anyone's idea, certainly anyone at the Fed's idea of the narrow. So Yellen's view has changed because of that, and I think that's a significant sustained shift. It's not something she's going to flip back on unless we get a very long further run of very weak inflation readings, which I don't expect. And again, I'll talk a bit about why I don't expect that. But I think the key thing to remember here is that, of course, right now the economic data are being distorted, or at least quite a lot of them are being distorted by the impact of the hurricane. So I think it's important to get a handle on where the economy was before the storm struck, and hence to take a view on where it will be when the storm effect fades. Yellen's view, I think, on this is pretty clear. The Fed's view is pretty clear. They're taking the same approach that they took after Katrina in 2005, which is to say, yes, it was horrible, but it wasn't really a macroeconomic event, certainly not a lasting macroeconomic event, and therefore nothing to worry about in terms of a sustained shift in the economy. It's not going to move away from where it was before the storms. Although obviously in Houston and the Florida Keys, things will be pretty grim for a while. But this is a very big country, and to get a national economic impact in any sort of sustained way is actually really quite difficult. So. So where were we before the storms? Let's just have a look at the picture. So the ISM survey, or the manufacturing survey, has been trending up, as you can see there, since mid-2016. It's now very high. Things have changed. I mean, in the olden days, ISM up in the low 60s, you'd be looking for output growth of 4, 5, 6%, sort of a raging boom territory in manufacturing. So there has been something of a shift since the crash. I don't know whether that's because the sample has shifted or some other reason, but anyway, where we've been over the last few years, these very high ISMs are still consistent with output growth only of about 2%. But this is a big change from the story in 15 when growth was slowing, and late 15, 16 when manufacturing output was actually falling. So a significant turnaround. And this is because of the fading of the effects of the crunch in the oil sector, when we had almost an 80% peak to trough a decline in capital spending after oil prices fell in the second half of 2014. And that triggered a really big downshift in the manufacturing sector, and pushed it almost into recession. Well, for a while, it was shrinking. A lot of people argued this was going to drive the whole economy into recession, but it didn't, because it was sector specific. It was purely a story about the oil sector and those bits of the economy that are connected with that. So once oil prices stabilized and drilling activity stopped falling, we've seen something of a sustained rebound. I expect that to continue. There's no reason to expect any change in the near future. At the same time that the domestic side is picking up, we're also seeing a nice pickup on the external side as well, which is a small share of GDP. Manufacturing exports are about 9 or 10% of GDP, so it's not huge, but I'd rather have them going up than not. And they're just trending to track the trade-weighted dollar. Again, since early 16, there's been a nice downward trend in the dollar on a year-over-year basis, and an upward trend in ISM export orders. So I'm pretty optimistic that we'll see some better trade numbers over the next couple of months. In fact, I think foreign trade probably will be a small add onto third quarter GDP. But the thing I'm getting much more excited about is the capital spending picture, where we're finally seeing some signs that the capital good orders are beginning to peel away from the path that's been implied by oil prices. So you can see there, just marking the last few months, those capital good orders, that's just the nominal dollar value of capital good orders from the durable good report. strengthening, whereas oil prices, which have been the driving factor for a while, suggest that those good orders, capital good orders, should be falling. I'm not saying here that the oil price is the only thing that matters for CapEx, but it has been the driving force of changes in the CapEx picture, which otherwise has been pretty flat and boring. But over the last few years, since that rollover in oil prices in 2014, shifts in oil prices have been the change factor, the source of variation in capital good orders. And here we are now with capital good orders picking up, even though the oil price picture says they should be going down slightly. And what's changed? Well, I think what's changed is on the next chart down, which is the NFIB survey, chart 4. NFIB capital spending intentions have strengthened quite markedly. They dropped in September, but that was probably because of the hurricane. So I've just got the July and August average there, looking at the rate of change rather than the level. This is very striking because the Fed specifically referred to it in the September minutes. That's really unusual for the Fed actually to draw attention and name a private sector survey, and specifically the CapEx component. It's very unusual. They tend not to do it. They don't really want to give a sort of stamp of approval to unofficial data, especially, I guess, coming from a lobbying, anti-tax, anti-regulation shop like the NFIB. So the fact that they did choose to mention it tells you that they're watching it pretty closely, and they view this uptick as being really quite significant, as do I, and I've been tracking this for a long time. So the capital spending data on the right-hand axis, the black line, that's business CapEx, non-residential, stripped out housing. I've also stripped out oil wells and oil equipment. So this is non-oil, non-residential CapEx. As you can see, it tracks that NFIB survey with a lag of a couple of quarters. So the NFIB is telling us where we're going to be next spring. So it's quite a useful leading indicator. What it's suggesting is that, again, before any short-term distortions with the hurricanes, the year-over-year rate was heading from about 2% up to 10%, which is really quite a big turnaround, add 1% to GDP growth. And if you're trending at 2 and you're suddenly trending at 3 for GDP, that's a heck of a big difference. Going to make a meaningful difference to the state of the labour market in particular, which is what Yellen's becoming very exercised about. And in this context, that's important because Yellen's been starting to make this point that, look, if we carry on with the labour market as it has been recently, then we're going to see the unemployment rate continue to fall further. So the Fed can't assume that unemployment now is going to level off happily at 4.2. I think last year they thought it might well level off at 4.5, but it didn't. The decline reaccelerated. And now, if the CapEx picture strengthens in the way that the survey suggests and the way that the hard data are beginning to suggest, then we're looking at potentially GDP growth accelerating, which is what some people have been arguing for a while, myself included, that the first few rate hikes might have the effect of making the economy stronger rather than weaker. Why? Well, because the Fed is now sending a signal that things are normalizing, and if things are normalizing, then it's safe to start spending some money. You contrast that to where we've been for the previous few years, where every 6 weeks I've said, well, we'd like to start normalizing, but everything's terrible, so we can't. That sends the opposite signal to the business sector. It sends a signal that it's not safe to borrow money and spend it on anything except risk-free things like buying back your own stock. Now, I can't separate this effect from simply looking at the unwinding of the drag from the oil sector, which clearly is a big part of the weakness in 16 as well. But certainly it's consistent with the idea that the extraordinarily accommodative policy wasn't really effective after the emergency was passed. It actually became counterproductive because it signaled that things were still terrible, even though they weren't quite so terrible anymore. And maybe things now are changing back the other way. You won't find anybody at the Fed willing to say that. In fact, the only person who did was Richard Fisher, who was the Dallas president, but then left, I think partly in frustration that that view wasn't being taken seriously. But here we are. We've raised rates in December, March, June. We're going to raise them again December this year. And the first half of next year actually could see some really very strong GDP growth and a further tightening of the labour market. On the consumer side of the economy, just moving away from the business side, very strong. A big gap between consumer sentiment very high and consumer spending, which is okay. There's not enough cash flow to support spending growth of 4.5%, but there is enough to support spending growth of 2.5 to 3. And if business capex is going to pick up, then I can certainly live with that. It's possible that that spending growth will pick up a little bit further, but the saving rate's quite low, and I'm certainly not putting into my forecast anything like a complete closing of that gap to the upside. I don't expect confidence to come down in any meaningful way in the short term, but I think the gap might just have to persist for a while with the sentiment readings all pretty elevated and spending doing okay, but not booming. In the short term, it's probably going to slow down because of the effect of the hurricane. So this chart of 5 here just shows consumer spending on a rolling 3-month growth rate basis. You can see before Katrina, the blue bars peaking at 5% and then all the way down to 0. Well, we weren't growing quite so strongly in the first place this time, but I don't think we're going to go to 0, but we are going to slow. And consumption, well, for the third quarter, I'm looking at 1.8, 1.9, and for the fourth quarter, well, something probably similar. So, there's a hit, there's unquestionably a hit, and a hit that's going to materially affect the growth rate for Q3 and Q4. But then, as we saw after Katrina, a nice big rebound in Q1. Something similar to that seems a reasonable bet this time around. We're already seeing, when you can see it screams out of the chart there on the car sales numbers, 18.5 million for September after 16 million in August. Now, it's a really big question as to what happens over the next few months, because nobody really knows for sure quite how many cars were destroyed. I've seen estimates as low as 250,000, estimates as high as 1 million. Nobody knows how many were actually destroyed or damaged by the hurricanes. Nobody knows how quickly people will seek to replace them. Though, if you live in Houston and you can afford to replace the car, you've got to do it pretty quickly because it's the only way of getting anywhere. Florida may be slightly different. But we could see these very elevated car sales readings for a while, in which case fourth quarter consumption won't be as weak as I've been saying. It could pick up more strongly, but I want to be a bit conservative in the forecast and assume that 18.5 million is going to be quite hard to sustain right the way through the fourth quarter. So I think we'll be above the previous trend, but not collapsing. Before the hurricanes, sales were leveling off at 16.5. We'd had a clear slowdown, but that followed an unsustainable run-up at the end of 16, when Ford started basically giving cars away, and all the other manufacturers had to follow. It wasn't sustainable. We had to have a correction. They just effectively stole business from 2017, and this year they paid for it. But I think we'll be above that 16.5 trend for a while, but probably not at 18.5. The other thing that's happening, going in the other direction now, are chain store sales, which were hugely elevated ahead of the storms, people buying tools and flashlights and batteries and plywood, now reversing, heading back to the previous level. But the important point here is not that we had a storm boom, boomlet, and then a mean reversion. The important point is that spending growth was trending at a pretty solid, 2.5, 2 3/4, having in the first quarter run at 1%. So the consumer is in decent shape. The pre and post storm boom in the Red Book was always exaggerated, but we're not going back to 1%. Sentiment is very strong. There is some cash flow around. There's no reason to think that spending is going to be going back to that slow pace. What I'm slightly surprised by is that the official data haven't picked this up yet, so there's a very good chance, I think, that the official retail sales numbers will be revised higher. This has been a consistent pattern, and I wouldn't be at all surprised to see the recent numbers pushed up significantly. The point, though, is that there's nothing wrong with the consumer. No reason to expect a raging boom, but certainly no reason to expect any material weakening either. With the possible exception of the housing market, where we've seen a bit of a weakening in home sales, new and existing, but they tend to track mortgage applications, and the mortgage applications data, the blue line on the chart there's a nice upward trend for the fourth quarter. So yeah, a storm hit, but picking up. I don't really emphasize housing anymore in the macro story because it's become such a small part of GDP since the crash. I'd rather have rising home sales and housing-related retail activity than not, but it's not the end of the world either way. It's not going to make a massive material difference. I think the next serious uptick in the housing market will come in the next cycle rather than in this one. Moving on to the labour market, well, again, before the storm's pretty solid, payroll growth trending in the high 100s. And then, of course, we get the hit from the storm, which pushed payroll growth down and pushed wage growth temporarily up. So chart 13 here shows that the hit from Harvey and Irma, the drag on payrolls, which is the blue bar relative to the previous trend, was quite big, but it certainly was within the realm of previous experience. Hurricanes and blizzards both do the same thing, push payrolls down, push wages up. They push wages up because the people who drop off payrolls during hurricanes and blizzards tend to be lower paid people. Why? Because it's quite hard to fall off payrolls because of bad weather. You have to do 0 paid work in the pay period, which includes the payroll survey week. Sounds like a very long-winded description, but it's very specific. The pay period that counts for people who are monthly paid is the month. So if you're salaried, you're going to count. If you're paid semi-monthly or bi-weekly, chances are you're going to count. Maybe you would be kept away from payrolls for a few days, maybe for a whole week. But if you're paid twice per month, you'll be being paid for some of that month and you'll count. So the only people who drop off are weekly paid people who did zero work for the whole week, or more likely part-timers who work 2 or 3 days a week. And those days rather, were the ones that were hit by the storms. And those people fall off payrolls. On average, they earn less. And average hourly earnings, the clue is in the name, it's not mixed adjusted. So when you lose a bunch of lower paid people, the average goes up. And that's why we printed a 0.5 for hourly earnings for September. I think the trend might be picking up anyway, but that September reading wasn't it. I wasn't excited by it because it was going to happen as a result of the storms. What I care about is October, November, December, and Q1, but we'll come back to that. Payrolls, well, again, before the storm, the payrolls are doing quite well. Chart 14 is my hiring index, which just takes a bunch of surveys, crunches them together, and generates a payroll index, which leads by about 3 months, and it tends to be a bit less volatile than the official data. Anyway, you can see that we had a nice little upward trend in the last few months, but obviously the official payroll figure for September is murdered by the hurricanes. Katrina had 2 bad months, followed by a huge rebound in the November, where the November was 337. So it wouldn't be at all surprised to see something similar this time, where we get a terrible September, a not so terrible, but still pretty weak October, and then a big rebound going into November, December. That's certainly what the surveys are saying. And I think we'll probably see a consistent message from jobless claims as well, which are now pretty much back to where they were before the storms. So labour market strength was pretty robust ahead of the hurricanes. If anything, things were strengthening. And as a result, the unemployment rate was continuing to decline. Now, this is quite important in the context of Yellen's apparent shift of position. So if we look at chart 16, the unemployment rate fell pretty consistently in 2015. Apologies for my inability to draw a straight line. And then the rate of decline slowed quite substantially in 2016. And then it started to fall more quickly again. Now, this is not just statistical noise. We're back to the impact here of the crunch in the oil sector, which began way back in late 2014. But the point is that the lagged effect worked through the rest of the economy. The oil business doesn't really employ anybody. It's a capital spending business. So what we saw was a gigantic drop in capex, but not much impact on employment, certainly on a national basis, invisible. But once that 76, 77% peak to trough drop in capex worked its way through and started pushing into the oil suppliers and the equipment makers and logistics and transportation and real estate and oil services and everything else, now you're talking about a hit in businesses which are not just capex businesses, which are much more conventional, which employ lots of people and do some capex. And so we saw a delayed reaction in payroll growth, which the surveys picked up in advance. The blue line, remember, is the leading indicator payroll surveys. There's a 3-month lag already applied to the chart. And you can see there that in second half of 15 and 16, they slowed down and the official numbers followed, and then they leveled off. Well, again, look across the unemployment rate, falling nicely in 15, then late 15, it begins to level off. It's pretty flat through 16, then it goes back down again. Well, again, look at what happened in 16 to the employment numbers. Slow down, level, accelerate. That's mirrored in the unemployment rate. And the point is that during 16, when unemployment more or less stopped falling, this made it much easier for Yellen to sound dovish and for the Fed collectively to be cautious about raising rates. That didn't last. I think markets thought it was going to last. The Fed initially in 2016 promised or said it was likely to raise rates 4 times and actually did 1. But it was the labour market data, it was the unemployment rate that allowed them to do that, or put it another way, forced them to do that and didn't let them raise rates any further. Unemployment to more or less stop falling. It was above the NARU, so they could afford to take the chance of not hiking, and Yellen was sounding more dovish. But then when payroll growth rebounds this year, or rather late last year, and the leading indicators say that it's going to rebound even further, now Yellen's got a problem because now the unemployment rate is at 4.2. So what the chart then does for the future, the period after the vertical line, is say, look, what happens if we just carry on the way we were before the storm? So I take the 12-month average for household employment, which is 202, and the 12-month average for the labour force, which is 110, and just run them for a year. Well, what happens? Well, you end up at 3.5 in September next year. 3.5. That's a long, long way below the area. The last time the US had a 3.5 unemployment rate was in 1969, and core inflation was 6%. 3 years earlier, it was 1.5. So the US has no demonstrated ability to run with a 3.5 unemployment rate without an inflation problem, and that's essentially what Yellen is now telling everybody. I think everybody wants to listen. That's the message, and that message is the other part of that message is it doesn't really matter what's happening to inflation today. The risk is it will come barreling down the line later, primarily through wage growth. Let's have a look at wage growth. Okay, so this chart 18 is the long-run relationship. It's basically a Phillips curve between the NFIB, jobs hard to fill, and the headline hourly earnings rate. As you can see, a gap opened up very clearly in 2013-14. It hasn't got any wider, but it widened out for a while, and wage growth as a result is trending at about 2.6, 2.7, whereas the historic relationship would suggest it should now be at 4.2. If it were at 4.2, the Fed would have hiked rates a lot further by now because that was a rate of wage growth that they couldn't tolerate. Okay, we could argue or discuss all day why that gap opened up. I'm not sure that it's very productive at this point to do that because what matters is what happens next. You know, the gap might have been some consequence of globalization or falling trade union membership, or I think more likely because people were just scared of asking for a raise in 2012-13 because the labor market was still pretty fragile. The point is that if we concentrate instead on the more recent period, and what I'm going to do here is just draw, I'm going to attempt to draw a vertical line, reasonably vertical, in 15. What's happened since then? Okay, since then we've seen a pickup in the NFIB, followed by a leveling off. There's the pickup, there's the leveling off, followed by a renewed pickup. In the wage numbers, we've had a pickup from 2 to 2.5, had a leveling off, and now maybe the beginning of the pickup again. It's a lot easier if we just take that data and redraw it on a new chart. But this time, what I've done is put the axes together so that we're accepting there's been a structural break, and we're saying, okay, since that structural break, how have the data behaved? And that's this chart here, number 19. So this is just since 2015, but it's exactly the same data as on chart 18. Now, I appreciate this is a short sample period. It only runs for 2 3/4 years. And you know, superficially, you could just say, okay, we've got two lines trending up, so what? That doesn't mean that they're correlated. That doesn't imply any causality. But hang on a minute. Let's just have a look at this. So, turning point, turning point, turning point, turning point, turning point, turning point, turning point. That's a lot of turning points in a short run of data. And the NFIB picked them all 9 months in advance. That's pretty remarkable. And what it suggests to me is that to assume now that this won't happen is kind of brave or possibly reckless. I think it's much more likely that it does happen. Now, that doesn't take wage growth to 4 or 4.5, but it does take it to 3.25. And when productivity growth is trending at less than 1%, 3.25% wage growth is a problem. And this is what Yellen's scared about. It's as simple as that. So I can promise you pretty much that if we see wage growth doing anything like this over the next 9 months, so that would take us through to the middle of next year, end of the second quarter of next year. If wage growth is at 3.3, then the Fed will have hiked in December, March, and June, and they'll be telling us in June that they intend to hike again in the second half of the year, at least once, if not twice. So, again, I can't promise this, but what I would say is that it's really quite striking how those little turning points have been predicted in advance by the NFIB survey. It's entirely independent, and a 9-month lead time is very important. But we know now that the Fed is looking closely at the NFIB survey because they said so. They talked about it in the context of CapEx, but if they're looking closely at that component, then they're looking closely at the labor market stuff as well. And Yellen has said over the years that she appreciates that the headline unemployment rate, and in fact all these measures of the tightness of the labor market are flawed. Nothing is perfect, but the headline unemployment rate is the best we've got in terms of the official data. and it's going to head towards 3.5. And the NFIB is the best of the I think the best of the unofficial data, and it's telling you a pretty consistent story that we're reaching a breakpoint in the labour market. We haven't had an unemployment rate below 3.8 since April 2000, and that 3.8 was reached for 1 month. There's never been a sustained sub-4 period since the late 60s. Formative years for Yellen, remember, and I think that period is kind of weighing quite heavily on it now because it ended very badly and very messily. It's something of a myth that US inflation wasn't really invented till 1973 after the oil shocks, but it was there in a really big way in the 60s. Okay, some things were different. The economy certainly structured was very different, a lot more manufacturing, and of course the Vietnam War was very expensive, and printing money to pay for that didn't help. But a 3.5 unemployment rate certainly didn't help either, and that's what Yellen's worrying about. Of course, if you were a dove, you would say just hang on a minute, take a look at 21 and the downshift in core inflation over the last 6-7 months. Well, it certainly is striking. I've been writing about the US economy for 21 years, every day for 21 years. I've never seen 5 straight months where the core CPI has undershot the consensus. It's really quite an astonishing thing. But what's really more astonishing is that there was no common cause for this undershoot. There were 6 separate factors that drove it down. And very briefly, cell phone service prices is the first one. That's Verizon in March 2000. 7% reduction, just offering unlimited data, which their main competitors already did. As you can see, we then mean revert to the previous trend, which is running roughly at 0, slightly negative. The year-over-year rate next year will shoot back up. Hotel room rates, quite hard to see any connection between wireless plan prices and hotel room rates. Dropped very sharply in July, rebounded very strongly in August, and rose again in September. What's going on there? Well, it might have been the eclipse. A lot of people delayed vacations from July until August, or it might just be noise. I mean, this is a very noisy data series. The sample size isn't very big, and the response rate isn't very high. Anyway, the trend in hotel room rates is running just above 0, which is consistent with the occupancy rate, which is also rising. Despite the emergence of Airbnb, hotel occupancy rates are still rising, and that's what's lifting room rates. So very noisy month to month, but the trend is rising slightly. It made a material difference for a couple of months in the summer, but it's reversed completely. Next, more technically, physician services. I think this one was a consequence of the increase in Part B Medicare premiums in January, 10% for new enrollees only. And I think doctors competed to attract new enrollees in Medicare. There's about 2.5–3 million people every year signing up for Medicare for the first time. And as those people sign up, doctors want to get them because actuarially speaking, they're going to lose some of their existing Medicare patients every year. So they now got the perfect competitive tool. Come to me and I will eat the premium increase on your behalf for a while. And so now prices are going back up again. Again, this is not a big component of the core CPI, but it took off a 10th when we had the big drop. It's nothing to do with the macroeconomy. It's nothing to do with any sort of trend or technological change or disruption from AI or any of that. No, it's just because the premium went up and they needed to compete. Next, clothing prices, much more straightforward. They just track the dollar. Yeah, there's a gap between them right now. The clothing price inflation should be at about 1.5, and it's actually at 0. But we've seen big deviations in the past in both directions. They don't really mean very much. It'll mean revert. The only one I think might actually stick is airline fares, where there's quite a big gap between airline fares and the rate of change of fuel prices. And I just wonder whether this is a genuine disruption. This is Norwegian on the North Atlantic route. I think the domestic airline business isn't doing very much, but certainly on the North Atlantic route, there's a lot more competition now, and the legacy carriers are suffering a bit of fare erosion. That might last, but it's a teeny component of the core. It's less than 1% of the core CPI. Couple other things. Owner's equivalent rent, a drastic slowdown in the monthly increases, followed by a rebound. What happened there? This has nothing to do with the rental market, nothing to do with rising supply of multifamily homes, nothing to do with falling demand. It's an entirely technicality. This is because owner's equivalent rent is estimated by taking actual rents, primary rents, which include utilities. When they do the survey, they include utilities, gas and electric are the ones that count. And they have to be stripped out when you're deriving owner's equivalent rent because homeowners' utility costs are measured separately in the CPI. So to avoid double counting, you have to strip it out of the primary rent component. This is overdone. So the BLS appears to assume that when utility prices change, the landlords pass on those changes up and down immediately in full, but they don't. So when you strip them out of the primary survey, you're stripping out something which wasn't included in full in the first place, and so the residual, which is OER, goes down when utility inflation picks up, which it did. So in the year to the spring of this year, utility inflation went from -4.5 to +4.5. That was a heck of a turnaround, 9 points to the upside, and that pushed OER down. OER is a residual. Last few months, utility inflation has gone back down again. OER has rebounded. What really drives these rental numbers in the medium term is the vacancy rate, which isn't changing very much, and wage growth. And roughly 1-for-1 increases in wage growth feed into rents with a very short lag. This is hugely important if I'm right about what's going to happen to wages over the next year, because it will push up OER by potentially 1%, almost 1%, and primary rent. They both move together. So that's 41% of the core CPI. You could be looking at core CPI inflation being pushed up by 2, 3, 4 tenths by rents alone. So it's quite a quick transmission mechanism. We tend to think of wages as driving inflation through production processes. You rising costs that work through production processes and work through the distribution chain and eventually hits the CPI. But actually, in terms of rent, which is by far the biggest thing in the index, it can pop through very quickly. Rents have a much smaller weight in the PCE. That's about half. So the impact there will be smaller, and the spread between PCE inflation and CPI will widen even further if wages pick up. But it will make a material difference to the wage numbers, and I would urge you not to be lulled into a false sense of security just because rental inflation year over year has dipped in the last few months on the OER component. It will go back up again. Of course, none of this answers the question, well, in that case, how come core inflation undershot again in September? Well, partly prescription drug prices, which are noisy. The other thing that surprised to the downside was used cars. That's not going to last, because used car prices have rocketed since the hurricanes. As you might imagine, there's a lot of people buying cars. So auction prices, which tend to lead the CPI numbers by a few months, have shot up, and chart 28 shows there pretty clearly that it's gone vertical. I don't know how long it'll last, but the upward pressure will have to come through into the CPI over the next few months. So having had used car prices drop in September, falling outright, I would expect them to rebound pretty slowly. So I'd be really very surprised if over the next few months we're running with low core inflation numbers. Even just stepping back from the car component, the storms ought to push them up. If you look at the period after Katrina or before Katrina, the core CPI was trending. So in the 6 months through August 2005, 0.14 was the core CPI monthly change on average. September, which was immediately after the hurricane, so analogous to September this year, was 0.10, so actually below the trend as it was this year. And the next two, which were October and November, 0.35, 0.25, so averaging 0.3, so way above the previous trend, and then it mean reverted. So I think entirely possible still to think that there will be some sort of hurricane effect on inflation in the areas that were affected, which was a big area, and potentially pushing up the national numbers. Stepping back even further from that and saying, okay, where are we December, January, February, March? Well, I think 0.2 is much more likely than 0.1. Because if these 6 factors are done, the used car factor is done, I'm assuming prescription drug prices will mean revert, because that's what they usually do. And I think we go back to where we were before March, which is 0.2. The year-over-year rate will then shoot up from March and through the summer because the base effect becomes unfavorable. We'll hit the anniversary of this year's weaker numbers, and we'll then be looking at core inflation a year from now on the CPI, well, 2.6, 2.7, 2.8, which would put core PCE perilously close to 2%. And this is what Yellen is worried about, because this is the problem with lags of monetary policy. Things take a long time to come through, and you can't wait. As she said a couple of weeks ago, you can't wait to get where you want to be with inflation before you start dealing with it. You have to deal with it before you get there. I think I'd probably argue that the Fed might already be too late, but we are where we are. We're going to see rates rising significantly further. I think ultimately they'll probably overdo it, because they usually do. Now, this is the problem when you're relying on backward-looking data like the unemployment rate, and then using those data to persuade you to pull a policy lever which then doesn't work for a year. you kind of set up institutionally to be too late raising rates, then to raise them too far, and then too late to start cutting rates, and then cut them too far. So structurally, institutionally, the Fed tends to be late, and I think I'm not willing to assume that this time will be different. You know, this time they'll get everything right. This time they'll stabilize the unemployment rate before it becomes an inflation risk. Well, I think that ship has already sailed, and we'll end up at some point with a recession. Recessions in the US tend to be sort of corporate debt service events. So just looking back at the last couple, when debt service, net debt service ratios for the corporate sector got to 2%, that was when the fun started in the economy as a whole. That required interest rates of 5.25 in the previous cycle and 6.5 in the cycle before that. I don't think rates need to go anywhere near that high this time around to push the debt service ratio back to 2. As you can see, I've got it happening with rates much lower. Why is that? Well, because there's a lot more debt around. And that's the reason why debt service rates in this cycle have not fallen anywhere near as far as they fell in the last cycle. There's a ton more debt. Just flip back for a second. So corporate bonds outstanding are at an all-time record high, much higher than the previous peaks, and way higher than they were in 2007. And loans outstanding are not as high as they were at the peak after the crash, but they're certainly been rising in the last few years, and they're not much different from what they were in 2006. We did see a crazy period of run-up before the crash, but we're not a million miles away from it. So overall, gross corporate leverage, there it is, non-financial business sector leverage right now is higher than it was in 2006. So there's a lot of debt, whereas in the household sector, obviously a substantial deleveraging. The debt is different now. It's a lot longer. So C&I loans being taken out at the moment are 700 days. The corporate loans, 20 years ago were 300 days. Typical loans being taken out in 2006 were 500 days. So the rollover risk will take much longer to crystallize in this cycle than in previous cycles. And the same argument applies to corporate bonds as well. So getting that debt service ratio up will not be a very rapid process, and it may be here that my forecast is actually too quick. But even on my forecast, we don't see a recession being triggered by debt service ratios until the end of 2019. Maybe it'll be 2020. Or maybe we'll see lenders tightening their credit standards long before we get there. That to me is the unknown risk for this cycle, because lenders obviously got their fingers, arms, everything completely burned and fried in the last cycle. And the idea that there was going to be some sort of reward for being the last guy lending got shot down pretty comprehensively. I think this time around it would be reasonable to think that lenders, mortgage lenders and bank lenders to business might well take the view that actually this time around the reward is for being the first guy to stop lending. Now, we'll see that in things like the Senior Loan Officer Survey, which I recommend keeping a pretty close eye on as rates rise further. And we'll also see it in mortgage lending standards as well. Average credit scores will start rising. Now, this isn't happening yet. Don't be swayed, by the way, by the slowdown in C&I lending over the last couple of years, because that is just lagging capital spending. C&I lending is actually a component of the index of lagging indicators, so it doesn't tell you anything about the future. But the numbers have slowed from 11% down to 1%, so it looks pretty dramatic, but it's going to pick up again. The leading indicators are things like the Senior Loan Officer Survey and mortgage lending standards. That's what I'm more concerned about. Again, nothing is happening there at the moment, but that's what we need to be keeping an eye on, because I don't think this is just going to be a story about debt service ratios. If it is, like I said, the recession will be a long way off, but goodness knows where the unemployment rate will be by 2019, 2020. I think we'll have the Fed raising rates more aggressively. So I'm with them. I think that we'll end up seeing rates rising more quickly than the Fed thinks. I think they'll do 4 hikes next year and another 3 the year after. So I'm rather more aggressive than the Fed, whereas the market thinks we get 1 in December, 1 more during some point in 17, and then that's kind of it. Well, I'm not suggesting that's impossible. I think that's kind of on the range of possibilities. I put it at the sort of left-hand end of the distributions, if you like, whereas I think the Fed's own numbers are actually not far away from what I would consider to be near the middle of the distribution, maybe even a little bit to the left. So it's not impossible that the Fed gets what it wants with 2 hikes, but I'm struggling to see how it would happen, given what I think is the underlying resilience of the economy before the storms, which I think will come back really fairly quickly. I'm not buying the inflation story as some sort of structural downshift, or I'm still less buying it as the idea of a cyclical event, because we haven't had a cyclical slowdown. It's hard to see why we'd get a cyclical decline in inflation. I think it's much more a rather bizarre set of circumstances. It's very hard to see what the connection is between hotel room rates and cell phone prices and airline fares and clothing. They look to me like very much unconnected events. So again, just to wrap up, and then happy to take your questions. The key thing, I think, is that the economy before the hurricanes was resilient, but showed some signs of accelerating rather than just bouncing around this 2% growth rate that we've had for years. Accelerating makes a meaningful difference next year. If it happens, it'll come through the capital spending component. That's where the action will be. If that happens, the danger is that the unemployment rate falls further and more quickly than the Fed currently expects. Yellen, I think, is getting twitchy about this already. Now, of course, Yellen may well not be the chair. I just don't know who's going to be the chair. Obviously, we've seen lots of names being bandied around. At this point, I don't know. But ultimately, the Fed responds to the inflation environment. And if the inflation environment is going to change in the way that I expect, with unemployment heading to 3.5% and core inflation heading to 2.5% on the CPI and heading towards 2% on the core PCE, they have no choice but to keep tightening. And if growth is 3%, they'll definitely be doing it, because that's going to give you payroll growth consistently in excess of 200,000. Now, you might say, okay, well, there's not enough people left, quality people left hired to generate 200,000 payrolls. Well, if demand's 200,000 and supply isn't 200,000, wages will accelerate more quickly. And wages is the Fed's obsession. It has been for the last 35 years plus. I don't think that's going to change. So I'm looking at an environment that's actually becoming quite tricky for the Fed quite quickly, and I think that explains a change in Yellen's rhetoric and has revealed her as a pragmatist. She's not a perma-dove. She was a dove by circumstance. She's a labour market pragmatist. She always has been in the past, and I don't think that's going to change. So I will wrap up the formal bit of the webinar at this point. I can see we've already got some questions, but please feel free to add some more. I'm just going to try and read out a couple of the questions and see if we can address those issues. So a question here regarding wage inflation. Let me just read it out. Last 2 or 3 years, several measures of inflation expectations have been on a downward trend. Is that worrying? And healthcare inflation in the core PCE has been very choppy. Is that going to pick up? Yeah. So inflation expectations tend to lag actual inflation. I mean, some of the inflation expectations numbers don't seem to bear any resemblance to reality. I mean, the number's still, what, 4.5% in the Conference Board survey. So other numbers are a lot lower. So they're responding to what I think has happened already in the inflation rate. If we were to see an abrupt turnaround in wage increases, I think we would see inflation expectations picking up. Of course, there's two sorts of inflation expectations. There's the survey measured numbers, which the Fed does talk about, but there's also what the market is saying. And break-evens would react, I think, very quickly to an acceleration in wage inflation. I'm looking forward, kind of, to see how the market responds to a 3 handle for hourly earnings, which we haven't seen since before the crash. I think that would make a material difference to market expectations. And when push comes to shove, I think that matters more to the Fed than to the surveys, the University of Michigan survey and the Conference Board survey, because they don't seem to bear a lot of resemblance to anything except what has happened in the recent past. Whereas I think the tips market and break-evens, the Fed views those as saying something about specifically about the future. Someone else is asking about the Fed. I kind of glossed over that, but just to give you a bit more my take on it. I wouldn't welcome Walsh as the chair, and I think he got it completely wrong after the crash. And had he been the chair at the time of the crash, then heaven knows where we would have ended up. A very dark place, I think. I don't know quite how strong a runner he is. He's not a macroeconomist. He's a political operator and a lawyer, and I think that there's already been significant pushback in the media, among the commentariat and Congress as well, about Walsh. So I don't think he's going to get it. Seem to be hearing more leaning towards the safe pair of hands in the form of Jerome Powell, who's also not a macroeconomist, but has been at the Fed for a very long time now. Liked by Republicans because he's seen as being regulatory light. Liked by some Democrats because he's seen as being sort of a safe pair of hands and kind of rational. But again, a question mark because he's not actually an economist. That's a different that's a different kind of setup that we've not seen before. Others, I mean, John Taylor, we're talking about them going very much into a rules-based sort of thing. I think, again, there's been significant resistance to that in Congress, and it's got to get passed, it's got to get the 50 votes. Who else? Well, people like, Gary Cohn, of course, was being touted heavily, but seems to have blotted his copybook with Trump after the reaction to Charlottesville. So his star seems to have faded. I wouldn't rule him out completely. Who else? Glenn Hubbard at Columbia is mentioned occasionally. Again, I wouldn't welcome him. I thought that he was very much in the pocket of Wall Street before the crash, and there's an awful lot of things that he said which would be played back to him in confirmation hearings that would be very uncomfortable. So my guess is he's not going to be nominated. I still think Yellen's a real runner. The fact is that Trump has said recently, his most recent public comments on Yellen are that she's done a good job and she's in the frame for the job. And that happened a few days after Yellen had breakfast with Ivanka. So maybe she should fit some more breakfast with Ivanka into her schedule and get the job back again. I think if she was offered it, she would take it. Anyway, we will see. Question: acceleration, unemployment, and GDP growth at this stage in the business cycle is unprecedented. What's the catalyst for this time being different? Well, beyond the observation, the NFIB's CapEx survey has gone up. Well, the point about this is that we've had a massive shortfall in CapEx. That's why productivity growth is so low. That's why our star has come down, because we've had a shortfall in capital spending. As a result, the capital stock has shrunk relative to normal, and it has aged. So we've got less capital equipment, and it's older, and therefore generating slower productivity growth. It's not the whole story for productivity. We've also got an aging population, which isn't helping, but it's a big chunk of it. So there is a sort of underlying rationale that when economic conditions normalize, we ought to see a capital spending recovery. So the pickup in the NFIB, to me, is simply validating what I was expecting anyway. I think there's a pretty strong business cycle case for expecting a late cycle surge in CapEx as companies realize that it's now safe to spend some money, which they didn't, because the Fed every 6 weeks for years was telling them that things were terrible. So that delayed and deferred CapEx otherwise would have taken place. Most of what I'm talking about here, to be clear, is replacement spending. Even at the peak of a boom, any boom, most capital spending overwhelmingly is replacement rather than net new. So the replacement cycle has been stretched out. That's why stuff has got older and the capital stock per unit of output has shrunk. So there's now kind of a pressing need to start replacing this stuff. And the door has been opened to that replacement by the Fed now finally saying, hey, we're normalizing policy because the economy is normalizing. The NFIB is capturing that. So this is very much a CapEx catch-up story rather than a consumption story. And maybe, fingers crossed, we might get a bit of an export boomlet as well. After all, global growth is pretty strong now, and the dollar is very competitive. So that's, exports are 12% of GDP. So it's not going to drive the economy, but at the margin, I'd be very happy to have it, that's for sure. So a question: forecast a potential unemployment rate of 3.5% a year from now, assuming inflation is not heading to 6% as it did in '69. What's a reasonable assumption of where inflation might get to? Well, ultimately, I think core CPI could easily peak at 3 or maybe even slightly above. Core PCE would be difficult to get there because of the way that it's structured. It's got a lot smaller weighting of rent, so it's less sensitive to wages directly. It's got a much bigger weighting for medical, which is another question. So just to draw that question as well, medical inflation has been suppressed by Obamacare, but it's because we don't know what's going to replace Obamacare, if anything, or how it's going to be changed. It's very difficult to know exactly how that's going to play out. I've been nervous about upside risk to medical inflation over the last year, which hasn't materialized yet. That's not to say it won't materialize in the future. We could see some very big premium increases, which will then filter into the costs of hospitals and doctors. Just to be clear about this, there's a big difference between the CPI and the PCE measure of medical inflation. So the CPI only measures medical services inflation for things that people buy directly for themselves. So it's essentially doctors' list prices for cash customers. Whereas the PCE is dominated by an entirely different component, which is not in the CPI, and that is the cost of medical services that are provided to people by third parties, in other words, by their employers via insurance. The insurance component is not the big one, because what the insurance component measures is just the net premium. What we care about is the cost of medical services. So it's kind of 3 stages removed from the consumer. So the consumer receives medical services which are paid directly by insurers who are funded by employers. And what the PCE is dominated by, the medical services component of the PCE, is dominated by the cost of those services which are provided by employers via insurers, whereas the CPI, only stuff you buy for yourself. What that means is that the big drop in physician services in the CPI, which was a big story earlier in the year, didn't happen in the PCE because the PCE is dominated by doctor services who are not affected by Medicare. Anyway, what this means is that actually the PCE medical component is reasonably insulated from Obamacare up to a point. You know, if we see the whole medical business in total disarray and insurers and service providers losing a lot of money because of chaos in Obamacare, then what they'll do is try and recoup some of that money from their insurance customers on the employer side. So I do still see some upside risk, but I'd be surprised if it were to be you know, a rampant burst of medical inflation. That seems pretty unlikely at this point. Again, there's a lot of wages in there though. So if wage inflation accelerates, medical inflation will pick up as well. But if wage inflation is going to peak at 3 in this cycle rather than 4, which is where it peaked in the previous 3 cycles, then the upside risk to medical is kind of capped. So I'm losing a bit of sleep over it, but not a lot. Will the Fed keep raising short rates if the long end keeps falling? So if the curve inverts, you know, what will they do? Well, I think what the market will say is, look, you know, rates have risen, curves inverted, so the market's telling you the economy is going to slow down, so you don't need to keep raising rates. Well, we hear this in every cycle, you know, oh, the Fed will stop raising rates because the market's doing the work for them. I don't think that will happen, because the problem is, if you take that view and you then you stop raising rates, then the market goes back to where it was before, and so you haven't achieved anything net. And again, this is another argument for the Fed ultimately overdoing things. They have to kind of leave their foot on the brake pedal for maybe longer than we might think is appropriate given broad financial conditions. And just to be clear, you know, if the Fed does raise rates 3 or 4 times next year, then I'd expect to see widening corporate spreads, a higher treasury curve across the whole curve. I'd expect to see a stronger dollar, which would be squeezing foreign earnings. I'd expect to see falling stock prices because valuations get hit. And if wages are accelerating, then margins get hit as well. So it's kind of a toxic environment potentially for all risk assets, commercial property as well, going into 2018. And obviously all measures of broad financial conditions will then, you know, a gap to the tightening side, and there'll be a lot of noises about, right, the Fed's got to stop raising rates. But if they stop raising rates, then all these things will reverse. So they have to keep going, unfortunately. And I think the peak in rates will be, you know, high 2s, and it might ultimately be 3. And just to answer another question that's popped up, obviously in the connection with this, what happens to the dollar? In light of the repatriation discussion, well, I'm going to kind of put that to one side because nothing is happening. There is no bill at the moment to repatriate. It's not remotely clear whether it's going to happen. You know, if we were to see substantial repatriation, then obviously that, and we're seeing rates rising at the same time, then, you know, you've got to be really quite dollar bullish. Ultimately, though, what matters here is what other central banks are doing. And just to be very clear, we don't have the ECB raising rates in the forecast horizon. We don't have the BOJ raising rates in the forecast horizon. We have the Bank of England maybe raising rates once in the forecast horizon, and we've got the Fed raising rates a lot. So it's very hard to see how this wouldn't be a dollar positive story. We do have the ECB reducing the pace of QE early next year, cutting it from 60 to 40, but that's still almost, you know, it's a $480 billion annualized, or 480 billion euro annualized run rate for QE. That's still an extremely easy policy, and they're not raising short rates. So we ought to see a stronger dollar, good for Europe, good for Japan. But of course, you know, adding to the pressure on US exporters and US foreign earnings, and ultimately adding to the slowdown story, which will emerge across maybe late 18 at the earliest, maybe 19. We have to see, but it's kind of hard to have an interest rate profile that we have and not be dollar bullish. So I think I'm just going to quickly scroll through. I think I've picked up on all the questions at this point. I've tried your patience for the last hour, so I appreciate you sticking with me. Please feel free to come back to me with questions after the webinar, if there's things you think of that you thought, oh, I should have asked that. Please feel free to drop me an email and we can carry on the conversations. I'd love to hear your feedback on how you think this has gone relative to our previous, you know, more conventional conference calls. So I think there will be an opportunity to answer a survey. You know, this is a new thing for us. I think it's better because it allows me to demonstrate the charts, and you get to ask questions during the discussion, and so I get to pick them up at the end. I think it's worked better, but your feedback is what counts, and so I'd hugely appreciate it if you take a minute or so just to let me know what you think. For now, though, thanks very much for participating. Thanks for your questions, and looking forward to doing this again soon. Thanks a lot.